Good morning, all. We want to look at our lectures for today. Today we're considering financial statement of a non-profit oriented organization. And when we talk about a non-for-profit making entity organization, we are looking at the organization that does not deal with buying and selling. And we know that an entity is described as not for profit making organization if and only if profit is not one of the primary aim or objectives of such organization, because the non-profit organization is established not with the mind or idea of making profits. Example of such entities of non-for-profit making organization includes the student unions, include the clubs, trade unions, professional associations, and churches. The basic objectives of these organizations, or why it was established, is to provide certain services or products for the exclusive enjoyment of its members. Like a church does not involve in buying and selling. They are established to promote the gospels of Christ, taking the gospels to the dying world. And when they are preparing their accounts, they are not aiming at making profits. That's why we call it a non-profit or not-for-profit making organization. Now, we equally look at where they are making what we call the sources of their funds. They are like other non-for-profit organizations, like clubs, like the institutions, like Chartered Institute of Accounting, Chartered Institute of Taxations, and other professionals associations. Now, the source of their income is just from the subscriptions from the members, the levies, the fees collected by the members, and sometimes some donations from friends, from governments, and so forth. And the church, the source of our income is from the tithe and offerings, it is from the pledges, donations that is being made by the members of the church. So we need to look at how these institutes or institutions, the non-profit organization's financial statement is prepared. Although it might always be like that of the business oriented, but there are some differences. We need to understand this first, that there is a difference between profit-making entity and non-profit making entity. Let me quickly state that before I come to this point now. Let's look at the difference. We talked about the, let's draw this, put this, and I'm going to have items here. Then I'm going to have another one here, three columns. The first one here is items. The second one here is profits making entity. Then this one will be non-profits entity. Now, let's take this item one by one, then look at the differences between the profit making and non-profit making. Number one, excess of income. You have excess of income over expenses. Now, the profit making organization will call these profits, while the non-profit organization will call this surplus. Now, the number two, excess of expenses. Now, expenses is more than income over income. A profit-making entity will call this loss, but non-profit will not call loss; it will call it what? Deficit. Another one is excess of assets. Excess of assets over liabilities. I give us note on assets and liabilities. Now, when the assets is more than liabilities, what does the profit-making organization call it? They call it capital. While the non-profit organization will call it accumulated. Accumulated funds. Number four, records of income and expenses. This one will call it profit or income statements. Why this will call it what? Income and expenditure. Income and expenditure accounts. Now the number five will be records of assets and liabilities. This profit-making organization will call this statement of financial position. While this will call statement of financial so this is what they have in similar. So that means that this is a statement of financial position is same thing as balance sheet. Same thing as what? Balance sheet. So this is basically the difference between the non-profit making entity and the non-profit making entity. So if you understand this, then you know where we are going. This one here, there's another one here. The profit making organization is always preparing cash book, whilst non-profit making organization prepare what we call receipt and payment. They are the same thing. So preparation of so this will call it what? Cash book. We talk about three types of cash books you have. While this will call it what? Receipts and payments. So these are the differences between the two. So we know that the one we're dealing with is this one, the last one, the non-profit entity organization. So let's look at the financial statements of the non-profit entity. Non-profit entity. Now, the profit making and not for profit making entities prepared financial statements for the same purposes of ascertaining their financial performance of an accounting period and financial positions at a particular point in time. So that means that the major objectives or aim of preparing financial statements is to measure the performance of that organization and also measure the financial positions of that entity at a particular period. So the financial statements of a non-for-profit making entity are distinguished from those of a profit making entity by using the difference I've just mentioned above. Now, for a non-profit making entity, it is net worth. Net worth is known as accumulated fund, and it can be derived using basic accounting equations. Now, in the profit-making organization, we said assets, assets plus liability is equal to capital or equity. So, in a non-profit organization, we are looking at accumulated. So that will be what? Accumulated fund accumulated funds is equal to assets. That is, if all its resources are provided by its members. So that would be that the accumulated funds, which is assets, that is accumulated fund, which is equal to assets minus liabilities. So this is capital. Remember the formats that I showed the difference between the profit making and now this is capital. So capital will be equal to assets minus liabilities. Assets minus liability. In fact, this equally means that if its resources are obtained on credit or on loan. The liability, we have the current liabilities, we have the long-term liabilities, we have the short-term liabilities. So if some of the resources were acquired on credit, this will be the outcomes equations. That will be the capital, the accumulated funds will be equal to the asset of the organization, what the organization owns, and what they are owing, and will give you the capital or the accumulated funds. Accumulated fund. Now, we need to prepare this. There's what we call special accounts prepared for the non-profit making entity. Number one, we look at the receipt and payments. Receipts and payments. Receipts and payment. Receipts and payments. Now, these accounts serve as a kind of control account over the cash accounts and bank accounts of a non-profit making organization, entity, organization, because it means that to ascertain the relevant details of all the payments and all the cash received, all the cash, all the payments received, either by cash or by check, must pass through this account. For these reasons, the opening balances of cash accounts and bank accounts are used as in opening entries, while the closing balances of cash and bank accounts are used as closing entries. Don't forget that this receipt and payment replaces the cash we dealt with for a profit-making organization. Three types of cash book. Look at single column cash books, double column cash books, and then the triple or triplet column cash books. But here in the non-trading organizations, we don't use that cash book. Rather, we use what we call receipt and payment. And receipt and payment, it means that all the money you received in whatever form was passed through this. And then all the payments, whether the money was meant to purchase fixed assets, was used for the operational expenses, whatever thing you use the money for, money goes out for, it must pass through this account. It must pass through this account called receipts and payments. It's different from the income and expenditure. So you should equally understand that cash book for the profit-making organization also absorbs all the receipts and all the payments, whatever payment you made, whether it was for fixed assets, it was for operational expense, every expenses you make must go through cash book, in and out, everything received. But when you get to the next account, you size them, as I'm going to see here. So the next one will be what we call this number one. Number two is income and expenditure. We saw this in the chart of the difference between the profit making and non-profit. Now, this one here replaces cash in the business, profit making. While this one here replaces profit and loss account. So the aim of this income and expenditure is to find out whether the business is running on surplus or deficit. So the basic purpose of income and expenditure is to disclose the surplus, that is excess of total income over total expenses. Let me put it like this. This is, it deal with surplus, the excess of income over expenses. This will be what? Surplus. So this is the main target of the income and expenditure, is to get us to this point, because at the last computations you will either get surplus or deficit. So the when we talk about deficits, if we have what called the excess of expenses over income. So that means that your expense is more than income. That will be what? That will be equal to what? Deficit. So this is the aim of preparing income and expenditure. Another critical one we need to look at is that computation of accumulated funds. Number 3, accumulated funds. Number 3, accumulated funds. In profits making organization, this is what we call assets or capital. So the accumulated fund accounts. This account is meant to indicate the worth of a non-profit making organization. It should be noted that accumulated fund always start with the initial resources contributed by the members of a non-profit making organization, and increases or decreases with surplus or deficit respectively for every accounting period. So there is always the starting point, that's the capital invested, and this will be piling up, accumulated up over a number of years. So it could be decreased depending if you get deficit here in your income and expenditure, it will automatically affect your accumulated. It will reduce it, it will increase it. But if it is surplus, it will increase your accumulated fund. So we must need to critically look at these 3 accounts, because we are going to use them as we move into the calculations and working on their financial statement of this important. So let's look at example here. Questions. Let's use illustration. Illustration. The question is, a church of God was founded on 1st July 2005, or sorry, 2007, with a capital of 100,000 naira, paid by cash, as well as computers worth 90,000 naira, and generator was also donated. 20,000 naira generator was donated by some members of the church. The following are the transactions carried out by this church within the first financial year ended 30th June 2008. Now, very small, I should write it. You may spend some little time. Now, on the 30th of June 2008, open a current account with office cash 10,000 naira. And on the same date, paid 2 years rent, 36,000 naira by cash for the church rent. We started counting from 1st October 2007. That same date, bought furnitures, 15,000 naira by cash, and some publications, books or Bibles, 24,000 naira by check. On the same 30th June, the church received some publications, books, worth 50,000 naira as donation from friends. Then on the same day, received a total of 150,000 naira tithe and offering by cash. And the same day, they paid for electricity bills of 12,500 by cash. Then on that same day, they paid salary for the part-time pastor, 15,000 naira. Then on that same day, the church received 75,000 naira as pledge. On that same day, donated cash 30,000 naira and textbooks 14,000 naira to indigent brethren. Then bought souvenirs for some pastors, 60,000 naira by cash. Then on that same day, purchased mosquito nets for pastoriums, 12,000 naira. And the church borrowed from the bank the sum of 25,000 naira by check as loan to solve some immediate problem. As at 30th June of 2008, the church had cash of 25,000 naira, and then bank statement balance shows 90,000 naira on credits. Then the question is that you are required to prepare prepared every necessary account and extract a trial balance as at 30th June 2008. B. Prepare income and expenditure accounts and a statement of financial position after considering the following. 1. Donations or tithe and offerings in advance, 20,000 naira, 24,000 naira, in arrears, 16,000 naira. Then 2, electricity bills, 1,500 owed and 5,000 naira was left unpaid. 3, included in tithe offering received was the pastor personal money, 40,000 naira, and was treated as income at 1,600 naira annually. Full depreciations, computer 10% of cost, furniture 20% of cost, generator 25% of cost, and textbooks, those publications, straight line method over a useful lives of 5 years, the scrap value of 6,000 naira. So here we have some of these questions. We can now take the questions as they are